And as always, we're going to be looking for accurate context, good risk management, and always exercising good patience.
Everybody who's traded has gone through periods of time where their strategy hasn't worked.
Where if not a hard stop, you should reevaluate the trades you're in based on time.
That's what we're here for, is to put ourselves in the best success. A trading routine does that, builds that habit, lets you know what to work on, what to reflect on, and what to improve on the next day.
Good afternoon, friends and traders. Welcome to the Limit Up Podcast. I am Dan Hodgman, sitting down with Jack Peltzer. Jack, how you doing today?
I'm doing phenomenal, Dan. Just about the end of my week. And you know where I'm going right after this for the first time in a decade?
I don't. You're going to have to tell me.
I am meeting up with a few old friends at the Sky Ride.
Oh, man.
So exciting stuff there.
That's really exciting. I apologize, Jack, here. I'm having some microphone issues, but I think I got it figured out. It's not letting me adjust. So, as you guys can all hear, I have an actual microphone today. So we got the feedback last week. We talked about it, and I'm glad to be here with a working microphone.
Dan, you sound a million times better. I was getting used to you sounding like a tiny man caught in 3 miles of HVAC tubing, just kind of whispering to me. But this is much better. Good background.
Look at this. It lights up and everything. I mean, it's a fancy looking little microphone.
Nice. Like the pictures behind you, too. Good stuff. Everything just better.
Well, I have moved locations. I'm continuing to travel in Nashville at the moment for the week. Who knows where we'll be next week? We'll have to wait and see.
Nice. Speaking
Awesome.
of things that are better, Dan, if we talk about today, woo, doggy, what a week it has been.
Well, I'll tell you what, Jack, I got excited. I said it over the last probably month or so, looking at crude oil. $95 was my level. If we can get some acceptance below that, we can see the market hold below, we may start to see the bottom fall out a little bit. We saw it start to break down yesterday, continues here today. Market opens up right at settlement price, right around 91.70. That market broke all the way down to $88 a barrel. I'm very excited about this, especially being that I am on the road in a vehicle that gets about 12 miles to the gallon. So that's pretty slick. But equities, on the other hand, really quiet day in those markets. We saw a huge up move yesterday. They stay inside here today. S&P kind of resolving unchanged. NASDAQ working its way towards overnight highs and looking to settle just a little bit up there. The talk of the town, though, on up moves, pretty interesting stuff's happening here. You've got gold and the euro tearing to the upside. And I say tearing, I mean really big moves here all night long. We got a great opportunity, though, when I look at the gold market, really a great opportunity right off the open. That market pulled back down to looking at our 30-minute charts. It pulled down into our 30 EMA. Really great bounce there. Good opportunity for a buy. We're looking for that weakness in an uptrend market. We found that weakness. We got a great opportunity to buy and take that trend all the way up over 1810. Good opportunity there. And 10-year note, quiet day, but making moves to the upside. So really some good opportunity across the board, and hope a lot of people were able to take advantage of that.
Looking at that gold chart, I don't trade a lot of gold. And by that, I mean, I don't trade any gold, but looking at that chart right now, it just has my other indicators on it. And just looking at this year, that's maybe the primest example of a golden cross and a death cross working out. Like, I'm just looking at this right now, and it just, that 50-day moves above the 200-day moving average, and it takes off, moves below. It got crushed. Now we're kind of going back through it again. I'll be keeping an eye on that. So obviously the big story here has been equities, right? I mean, what a week. Whether or not this is a bear market rally or the bottom's in or a short squeeze, it's really something. And I'm going to stick to what I was saying last week about kind of launching around that 4,200 level, which would put us firmly above the last kind of takeoff before things got crushed in mid-June, end of June. And because I think that's where FOMO raises its head, right? I think right now the people with money on the sideline aren't too concerned yet with that, because everybody seems to think growth is slowing. This is going to go down. People are just getting squeezed. But if it keeps on going up, might be time to put some more irons in the fire, so to speak. So that is what I will be watching out for, Dan.
I think you're spot on, Jack. There's going to be a lot happening. I said it last week and I'll say it again here today. I think midterms are going to have potentially a big effect on the equity markets. I shouldn't say good, but a big effect on equity markets, depending on the outcomes there. And I think leading into it, right? Like we all know how politicians are. They want to, if they're currently in office, they want to do everything they can to earn some more votes going into the midterm. So we may see some things come back into the civilians' favor here as we see oil starting to come down. Maybe they'll start to try and push some legislation to see oil continue to come down, to say, hey, look what we did while we were in office. We got oil down over the last year. There's going to be some opportunity, and I'm excited about it.
Well, I forgot just how long this war in Ukraine has been going on, with oil in the last couple of days crashing through the 200-day moving average, which is up there around 90, as you said, 95, your level right there. I don't know if that's coincidence or just something that you were picking out of air, but
been looking at that level for quite some time.
Yeah, well, there it is. It's really going to be fascinating, as you said, moving through the rest of the year. We're out of the driving season here, whether or not the oil keeps on this new trend, which is weird to say that it's going down, but it's been, it topped out on the most recent rally at about $123 a barrel. And just like the market, it's the same turnaround there. Mid-June was the high. It's been kind of peeling off ever since. So we'll have to take a look at it.
Yeah, let's keep an eye on it. I mean, obviously, oil over the last couple of years has been on this trend higher. So I'm excited to see it coming back. $55 is really my benchmark for barrel of oil. It's where I like to see it. I'm happy on both sides because that means people are working still. And we're paying a really fair price for gas at the pump. So fingers crossed.
Fingers crossed. One extremely important note before we head to the topic du jour. Two actual notes. One, watch out. Next week, I believe we have the CPI number, where my prediction of lower better come true, or I don't know what I'm gonna do with myself. I might just have
you got to give me $5 if it doesn't. Right? Is that the $5?
I'll take it further than that. I think I might just have to quit my job and become a wandering nomad, sort of like
what
a
I'm
monk
doing right
like
now,
that.
Jack.
You
I'm
are
all over the place.
And yeah, that's what happens when the market, when the ES hit 4,000, you had to do it. So
I had to hit the
road
road
as well, but definitely keeping an eye on that CPI number next week. One would think, with how much commodity prices have reduced and all this other stuff since the last one, that it would be down, but who knows anymore? Numbers are all crazy. The second thing, quick plug, it's the Top Step 10th anniversary birthday campaign right now. So check that out. We had a whole coach's playbook about it this week on Tuesday. There's your plug. And to get to what we're doing today, Dan, which is a topic that I am really excited about. You ready for this?
I'm pumped.
I am pumped as well. We're just going to talk through how risk management works at a prop trading shop. Or any professional operation. Now, granted, Dan and I are going to talk about our own experiences, and there might be slight variations, but I think that overall you'll see some of the same things no matter where you go. So, Dan, without further ado, I'll let you start.
I like to start. So,
yeah,
I want to kick this off on my end of things here. And number one, I've heard from a lot of traders going through, the trading combine, the rules are really tight and things are tough. I can promise you at any prop shop, your rules and your restrictions and the contracts you're signing, a lot tighter. Granted, it looks like you have more cushion and more room to play, but you've got someone watching every move you're making, especially in the beginning of your career at a prop firm. They're watching every little step of the way. Even to the big successful guys, I can tell you those are sometimes the ones that they have to watch the closest because they're putting the most risk on the table. So there's those things, like even if you're the biggest trader at a firm and you're one of the most successful, you have some of the biggest eyes on you because everyone's watching exactly what you're doing. So it's just things to keep in mind. Like as you grow as a trader, risk management doesn't go away, and sometimes it gets a little bit more intense. So my personal, oh, go ahead, Jack.
I was gonna say, Dan, maybe it'd be helpful too as we do this. Describe also the size as far as people at the shop, so we can kind of like show what sort of levels are involved. So as you start to describe your place, maybe that'd be helpful.
So we were a smaller firm. The one I'm going to refer to, we were a smaller firm. We had about 20 of us trading there. And there's a lot of team trading. So I was on the yields team. We were trading yield curve, and we had a head trader. He was like a 35-year veteran, phenomenal trader. He was like the guy that you just brought in if you were having a bad day and you called him up and you said, his name was John. And you go, John, I'm struggling. Hey, don't worry. I'll come in. We'll make a quick couple grand. And like, he'd just come sit at your desk, help you make a quick couple grand, and you walk away and you're like, wow, that felt really good. I needed that. So that was our breakdown. So you had John. John was kind of our head guy, but we also had another guy that was strictly a risk manager. He did not trade, and he had everyone's positions up on the board at all time. And he knows each and every person's contract. So for me, when I started at the younger end of things, like my size was relatively small. Trading yield spreads, I was not allowed to put on huge positions when I was trading yield spreads, max 5 to 10 lots, which they're pretty big contracts. I mean, they're pretty expensive contracts as well. And there's a lot of margin involved. I was allowed to carry weeklies only. So I was not allowed to carry over a weekend, and I had to be out of positions every single Friday. So we were allowed to carry a position Sunday night through Friday afternoon. And we were big position traders. And so there's step number one at Friday as I'm walking out of the office, or if I was working from home, I'd call in and say, all right, I'm signing down for the day. Had to check in with the risk manager, let him know I'm out, and we were shutting down. And he would go pull up my positions, make sure everything was flat, double check what I did on the day. So we had that one. Risk limits. So we were percentage based. We were not given a dollar value, say you cannot lose more than X amount. We were strictly percentage based because we were building positions. Obviously, I'm not just outright trading the yields. I've got positions against it. I'm putting some options on against it. I'm trying to control that net position to grow.
Would you see the entire, because I never traded options, so ours were not exactly this way. When you say percentage, so you would see the total value of your position, or were you able to see your total capital? Because that was the thing, like we never saw at our place, we never saw the capital we were trading. Our P&L monitor was at 0, and you would make money or lose money, but you never saw what was going on as far as our actual stack, so to speak. That was kind of hidden information.
So we were a little smaller. Our stack was right in front of us. I had 500 grand sitting in the account, and when we'd go 100 up, we'd bring it back. We pull 100 out, we'd bring it back to 5. Okay. So we had, every person had basically their own separate account that had a stack of cash in it, and you could see everything. We were small time. You guys were big time. We were the mom and pop shop in a sense. So
when you say that you had a percentage limit, it was of that starting capital, or of my starting capital. So obviously every day you come in differently, and every day it changes too, right? Like we strategize. So we had a team meeting every day at 5:30 or 5:45 in the morning. And we would all strategize what's the market's going to do. Like we get together. We actually had a phenomenal strategist out of Indiana. This guy was old school, like back to paper charts, like drawing them himself. Phenomenal statistician. And we'd get on a call with him. His name was Howard. And we get on the phone every morning with Howard for about 45 minutes to an hour. And we'd strategize. And then we go, okay, today my limits are going to be 10%. I'm going to get 3%. I'm going to go 5%. And then sometimes, hey guys, I have a really strong position on, I got to open this thing up a little bit. I'm going to go 15%. We tried to create those limits. They were not hard stops, because as soon as you start putting options on too, you're based off of theoreticals. There's only one program really out there that gives you a good P&L, because your P&L really doesn't get calculated when you're carrying position options until settlement hits, and then settlement hits, and you have to run P&L. So it's all relatively loose. So we're just watching it. We're risk managers really just watching market is moving higher or lower, net position is long or short, how are they trading against us, and what size do they have on. So that was really how it went. I'm going to give an example of when things go wrong and the risk manager has to get involved. Now, this was not me.
This was another guy in the firm. He was trading an unregulated Texas oil. There were not a lot of traders of this in the world whatsoever. It came out of 4 different plants in Texas. It was a pretty unique style of trading. He was the big dog in the office.
Mhm.
And his contract was weeklies. He was not allowed to trade more than a weekly out. He was trying to trade monthlies. They had him locked into weeklies. And he had some risk limits put in place, and he had contract size. So he was not allowed to trade larger than 4 lots. These were like every tick movement was like $100,000. These were huge movements. So he would see 7-figure swings on a daily basis, like it was nothing. So he went ahead and put on a weekly position on a Friday, walking out of the office after checking out with the risk manager. So the risk manager cleared him, checked him out. He went and put a monthly position on a Friday afternoon. Risk manager checked out after he said he was good. Went home Monday morning. We all came in and we heard that he carried a position over the weekend. It was, it was an astronomical amount against. He got locked out, tagged out right there. Security had to come get him out, and we had to close out his position. And the hardest part was the reason risk management rules are in place. We could not close his position because there was no one on the other side to fill the order, because it was so few traders on this, and it was such an illiquid market. So we just kept watching this thing run against us. Clearing firm was at our door, knocking, trying to figure out what was going on. Bosses had to put up collateral to cover the losses and prepay the losses before we even realized the losses. All because this guy deviated from one little rule.
Yeah, well, that's a pretty big F up there. Basically, all traders out there, stay away from super liquid markets unless you are actually involved with them, right? I mean, this is the same thing happens if you go way out on the futures curve to those contracts in the future that exist but are not on the run yet. You'll see hugely gapped markets there, and there is some opportunity to be had, usually from dum-dums putting in bids or offers at some price, not knowing what they're doing, right? I've seen it before. I remember watching some futures market, and our CEO at the time got super upset that none of us like lifted this random bid or offer. He's like, you guys should have known. Like, we're not even looking at these things. We're just trading on the run. And he was just basically somebody made like, $70,000 or something just by like picking off this one thing. Mm-hmm. But anyway, what I wanted to do is talk a little bit about the similarities and differences between our places of employment in the past, and then also tie it into the rules we have with the trading combine. So like Dan mentioned, I traded for about 7 years at places ranging from the first place I was at. We saw it go from about 40 employees to say 300 employees, of which usually about half were traders and then half developers and stuff like that. And then we were acquired by a place where I was trading that has like over 1,200 employees.
That's
so
a big one.
Big operation. So here's what it looked like there. And it's actually a little bit closer to the trading combine. It wasn't percentages. When you got your own account, it was called, you'd start off as a trading assistant. You paid your dues for about a year and a half, of which you were working overnight, generally watching people's books overnight, the actual traders. And it was a big deal, usually happened on like a January 1st, when you got your own account. That meant A, you didn't have to deal around nights anymore, which sucked. And B, you could theoretically start making real money. Okay. So
I like that you put the caveat of theoretically.
I think it has to be. I think everyone falls in the trap of extrapolating their trading performance of like, I remember like the first month of trading my own account, it was just a pretty good month in general, not necessarily because I was great, just everything was kind of clicking and working in our favor in the markets, and just kind of extrapolating out like, well, this month I did this, and this is my first, so I'm only going to get better. And so this is the minimum I'm going to make is like 12 times this year. I'm going to be a badass trader. That really wasn't the case.
Reminds me of the song, I'm going to be a millionaire.
Literally, that's what I was thinking. It's like, this shit is easy. It was not. Anyway, from a risk management, so they would start you out with a daily loss limit. We call them puke limits. It's really exactly like what we have in the trading combine. Ours was a fixed dollar amount, and as you made money, you could talk to the risk manager. We had the same format where, okay, you had trading assistants, traders, and then senior traders, which were the group heads. And then on top of everything, we had the risk manager who sat in his own office, like a little troll cave, and had everyone's position. So we had in our groups, you would have the P&Ls of everybody in your group. Theoretically, it was rarely done. You just need the other person and group's permission. You could go talk to someone and have them on your P&L monitor, but that didn't really happen. So we would see the group, the risk manager sees everything. It'd be a fixed dollar amount that as you made money, you could talk to the risk manager about expanding. We had 2 limits, both of which are rules in the trading combine, right? We had daily loss limit, which we call the puke limit, and we had position limits for each of the products we traded, the overwhelming majority of which were different treasury durations in futures. Cool. So that's where we're set up. As mentioned, the difference is we had no idea at our prop shop, we had no idea how much collateral we were working with or how much, how big our stack was, so to speak. When I came in each morning, if I had a flat position, like didn't do any trading the night before, it was zeros across the board. And as I put on positions, it would either go positive or go negative. And that's just money that I don't know where it came from. I don't know where it went, but it is now mine. And then from a risk management state, so we had those 2. And then beyond that, what do you think about, so we get in trouble sometimes with the weekly loss limits we have in the trading combine. There's things that are similar in a professional shop, but not quite the same. Like beyond your daily loss limit, if you blew out and got out at your loss limit and then did it again the next day, okay, that would be not good because
Not good at all.
you're just expected, if you have a bad day and blow out, to be trading less. Like say today, I'm only going to lose at absolute most half of my actual loss limit. And if you continued to do that, you would never get to like a weekly loss because you would just be like told, stop doing that. What are you doing? You got to like size down. So I presume you guys had a similar sort of situation.
Yeah, I mean, the one thing I will say between the prop shop and where we're at in this retail world, whether you're in the trading combine or you're trading your own brokerage account, at a prop shop, we had accountabilities. We were accountable to the boss, the owners, the investors. We were accountable to them. And like, we were a true employee. We were not doing our own thing. Like we had a lot of restrictions around when we were allowed to do it, how we were going to do it. You know, most people did not get to do the work from home. Like you had to be in the office for the 5:45 a.m. phone call. Like it was a real job and your job was to make money. And if you were not making that money and covering your desk fees, you were gone. So let's say, like you said, Jack, you hit the puke limit on a Monday. And if you come in on Tuesday, number one, like no one's going to say anything to you. Like, all right, well, you had a bad day yesterday. I hope today's a better day. No, like that's just the expectation. Like they had expectations that we were going to make money. And if you didn't, well, it was not a, well, let's try this again. Let's keep pushing at it. It was shut down the computer, disconnect your logins and, turn off your key card to get in the building.
Yeah, there was no work from home for us either. Maybe there was like 2 guys who were allowed to trade from Austin for 6 months, but they had been with the firm for maybe 10 years at that point. I think that what you say
we
is
didn't have
right.
night crew. So we all had to have setups at home and we would take turns at night watching the risk boards.
Oh, that's lovely.
Yeah, very fun.
I'm trying to gather my thoughts on this. So I had something I wanted to say that you reminded me of right there involving what was it, Dan? I'm having a
All right, I'll
minor
rephrase
stroke
what I
right
was.
now.
I will say what I was saying again. It was they had expectations. We were going to make money. It was our legitimate job to make money.
That's what it was. Yeah, you've
Okay.
jogged my memory now. Thank you very much. It was about the idea of desk fees or data fees. I think that there's maybe a misconception about how professional trading works. The thought being maybe that you don't pay those things, but you mentioned desk fees, and you very much pay fees to trade at the firm. You're a full employee with a W-2 and everything else, but if you're not covering that, and we're talking once you put in your data fees, your CME membership, your computer rig, whatever else they want to put in there, thousands of dollars per month. Maybe,
Oh yeah.
I think, once again, I think I can say these things now. I think I was paying maybe $10,000, $12,000 a month in desk fees. So what makes it kind of a stressful job is if you're not clearing those desk fees, you are in a very precarious situation as far as your future employment. So that's why it's a benefit to be able to kind of, trade when you want and stop. And you should stop at a certain point, but you can only stop for so long before those desk fees start eating you.
If you miss desk fees on a month, let's say you didn't hit that number on January 31st and you come in on February 1st, are they going to say, were they like hitting you up and saying, all right, Jack, you're 2,000 short of desk fee before we can, let your computer turn on, you got to cover that $2,000, or will they let that carry over?
No, because it would just come out of, so we didn't have, I guess I can just explain this all now. Our accounts, right? We knew we would get statements every day that said how much money was ours in our account. And we had to keep a minimum there that was way more than desk fees.
Okay.
Right. So it would just come out. The problem is you're just eating into your stuff at that point. And you talk about deals as far as, what your back and forth is. It was common in those things. So we were talking about your take home, your part of that would be like, after your desk fees, 30 to 50 at the most % of what you make beyond that is what you get. So, but I mean, what you get with that obviously is it's a very different sort of trading. We had a very, very large fixed cost. We had 100+ developers. And so for a long time, I didn't have a losing month. In my 6 years of trading, I don't think I had a losing month until the end, like the last year. And I think that those things are obviously highly correlated. You might start seeing in your mind why I decided to call it the end right there.
Mm-hmm.
But that is sort of how that all shook out.
Yeah,
we
were pretty similar in that. Like, you had to keep certain amount in the account. What was yours versus what was the firm's? Then I think you brought up a good point too, right? After desk fees, you still have a profits, but like, just because say your desk fees are 10, you make 20, you're not pocketing 10, then you got your split with the firm, and how that split works, that's different. So like, we were team split. So everything we made went into a pot. The bosses got their chunk out of the pot. And then that pot would be broken down. Like, okay, this trader gets, 10% of the pot. This one gets 5%. This one gets 12%. Like, and it was a breakdown based off of where you fit in the team and how you contribute to said pot.
Obviously you have to do that for options and stuff you were doing, but I didn't do team trading until, once again, the last year. And I think that's another thing that messed. You talk about trading being all mental. Like, a lot of it was the environment too, but I could not that mess with my mind. Before that, it was purely eat what you kill, as they say. And I was much better at just trading in general, managing risk, everything else, when I knew that I alone suffered the downside or the upside. When it was two guys who I was pretty close with at that point, and one of them had kids and stuff like that, I just could not do it. I don't know.
Interesting. I found that like one of the best things for me was like I had other people and I felt more comfortable like talking about the trades I was taking. When you trade a little bit more illiquid market, like a lot of times you don't want to really share your strategy that you're doing that's working, because then someone else is going to hop on and then that strategy is going to stop working as much. But if you're all in this together, like it's like, hey guys, I'm finding this level's hitting every single time as it breaks down here, look to fill and we'll get that. But whatever, however you're looking at it, or, this butterfly spread is actually paying out really, really well right now. And I keep seeing a guy come in and hit this butterfly spread. They're seeing 100 every time. I'm filling 25s. You get 25, you get 25, you get 25. And like, we could start working this together. So we started working like strategies and it felt kind of fun. Cause then you did feel, I would say I felt kind of like beholden to the other guys to control my risk. And I also felt absolutely okay. Like, normally you never look over your guy next to you shoulder to see what his P&L is for the day. But once we got to that point, like I was very okay looking over his shoulder and smacking him upside the back of the head if he was doing something wrong.
From the risk management side, I get the team thing. I do, because of what you said right there. And also one final thing about that is the reason they would have us hold all this money in collateral is, once again, a risk management thing. You have a lot of power if they give you access to a market like that. I mean, if you go rogue and just start hitting bids and lifting offers as quickly as you can, there's not much they can do about it. So they kind of have to have a minimum they hold over you to make sure you don't go nuts. Like we will do that episode in the MF Global guys someday, as Robin wanted us to. But I think we can carry this over. I'm going to be out next week, Dan, but maybe the week after that, we carry over to talk a little more about this stuff, because I think we could go on for another half an hour.
I think it could.
Right,
like, I have like 10 more questions. As we've talked, I was like, oh, I want to hear how it went with you guys.
I do as well. I want to talk more about this. Maybe we'll compare, because I find it fascinating too, to learn more about what you guys did as far as options and things like that. So we'll continue this on.
Let's do it.
For now, everyone.
Prop Shop number 2.
Prop Shop Part 2. Well, it's interesting. The reason we're doing all this is, I think, to kind of firm up how similar in a lot of ways what we're trying to do with the trading combine. We don't always succeed, but we are trying to sort of replicate the prop shop experience. And I think some of these, rightful frustrations that people will have are also frustrations that professional traders have with actual prop shops, because it's sort of the way the industry works and has to work, because it's all based on managing risk, right? Because we're all, if you get a funded account and you're actually trading the futures market, we are kind of beholden to you now. You are trading live futures in the market. And if you lose a bunch of money, it's not coming from nowhere, right? So that's, it's coming from our kids' college funds, right? So that's why we kind of can be, into that stuff. So let's continue this next week, Dan. I'll let everyone off for now. As we say at the end of an episode, namaste and trade well. We'll be back in 2 weeks.